Hi folks, and welcome to this video on inventory. Now the reason I decided to do a video for you, a couple of reasons. First of all, just know that most students don't have a big problem with the chapter, but sometimes students are looking for different ways to present things because they might find some of the presentations in the textbook a little bit confusing. So I thought I would present you with an alternate way of presenting the material in a chart kind of a format. It might be easier for some people to follow if they're trying to better follow the flow of inventory. And I also thought I'd add a piece here on calculating ending inventory and cost of goods sold if you were using a periodic inventory system. So in the question you can see here that for this company I've given you some information on their inventory and some of the activity within the inventory. So you can see here at the beginning of the month they started with 2,000 units, and then throughout the month they purchased and sold some units. First thing I want you to do is to determine MML's cost of goods available for sale, and that's going to be equal to beginning inventory plus purchases, because whatever you have to sell during the month of October here is based on what you started with and everything you bought, which is beginning inventory plus what you purchased. Right? And then I want you to calculate the cost of goods sold and ending inventory at the end of the month, or the ending inventory at the end of the month, and cost of goods sold throughout the month of October, assuming perpetual system and either using FIFO or weighted average cost flow assumptions. So cost flow assumption again is looking at how is the inventory flowing out of the business. So I want you to look at FIFO, which is first in, first out, and weighted average. And then in part C, I've added this part here because I want you to redo what you did in part B, but instead of assuming a perpetual system, I want you to assume a periodic system. So I want to make sure that you can do both of them. Some students say, well, do people use periodic? Well, yeah, some companies do if they don't have a lot of inventory transactions throughout a period, or they have larger items. You know, sometimes perpetually they might not use a perpetual system. It might not pay them to get that level of accuracy that's associated with perpetual sometimes in terms of what's in inventory, especially if they don't have as many transactions. So we do find periodic use from time to time. So I think it's a good thing that you know that kind of a system. So notice here one thing. I asked you to calculate cost of goods sold and ending inventory in part B, but part A, to determine the cost of goods available for sale, that doesn't matter whether you're using FIFO, weighted average, periodic, or perpetual. That answer to part A is going to be the same, because whatever you have available to sell is what you have, right? Where it's going to be different is you will get some different answers for ending inventory and cost of goods sold if you're using FIFO versus weighted average, and many times if you're using periodic versus perpetual. So that's why in part A, I think it's important that you know the cost of goods available for sale is not going to be different under a perpetual or a periodic system, and it's not going to be different under FIFO or weighted average. So this piece kind of stands on its own. So that's where we're going to start. So let's go down here first of all before we begin, and these are some of the tips that whenever you're doing a problem with inventory that you might want to consider. The easiest way to start anything, calculate cost of goods sold, ending inventory, first of all, how many units are you costing? So if you went back and looked at our question, we can see here we've got units that are available for sale, and within that we either sold them. So whatever we have available for sale, we either sold it or we didn't. If we sold it, it's going to be part of our cost of goods sold. If we didn't, it's going to be part of our ending inventory. So that's why they ask you here, first of all, find out what you have to sell, because what you have to sell is either going to be in ending inventory or sold. And then you can find your cost of goods available for sale. So that's why in this question we asked you to do that first. Now, don't forget to include the units and cost of opening inventory in your calculation. Sometimes students forget, especially when they're doing cost of goods sold calculations. They'll say, well, I sold some inventory, but I can only sell from inventory that I bought during the month. No, if you had beginning inventory, then you would have sold that too, particularly if it's FIFO, right? So under FIFO system, first in, first out. So the inventory that's been there the longest is sold first. So if you had something in beginning inventory, don't forget to include that in your calculation of cost of goods sold under FIFO, right? So don't forget to include that. And again here it says when calculating FIFO amounts, remember that the cost of units in opening inventory will be assigned to the first units sold. So in other words, the first units to be sold are going to be coming from the units that have been there the longest. Sometimes I say to students, first in, first out is the same as last in, still here. So because any units that are left at the end were purchased later than the beginning inventory items, right? So again, don't forget to make sure that you consider what's going on in opening inventory or what you have, particularly under a FIFO system. Now, when you're calculating weighted average amounts, remember that every time you put something into inventory, recalculate your average price of your inventory, because you never know the next time you're going to sell. So you always have to make sure that you recalculate every time you buy new inventory, recalculate the weighted average price per unit each time you buy. Why? Because you never know the next time you're going to sell. Those goods are going in at cost, but they're going to come out of inventory at the weighted average cost. So when you're doing a weighted average cost calculation, right, particularly when it's perpetual, when you sell, it's going to come out at the most recent weighted average cost. So under perpetual system, you have to make sure that you're perpetually updating your weighted average price per unit every time something goes into inventory. And then the last thing we want to remind you of is that every time when you finish a question, make sure that the total of your cost of goods sold in your ending inventory is going to give you the cost of goods available for sale. Because don't forget, whatever you bought that's available for sale, you either sold, so it's going to be part of your cost of goods sold calculation, or you didn't, meaning it's going to be part of ending inventory. So now let's begin, and what we're going to do is, again, we're going to assume perpetual FIFO. So let's go do that first. So I'm just going to scroll down here. Now in the solution, actually I shouldn't have started it that way. I'm going to do part A first, which is this, right? Determine match its cost of goods available for sale. And that doesn't matter whether it's FIFO, weighted average, periodic, perpetual, nothing. It doesn't matter. Let's figure out what we had available to sell. Well, what I did here is I basically took the question and I took the units and the cost. And what I did here is I came up with the total cost of all the units that we had available to sell. So what I did here, these units here that are in purple, is what I had available to sell. So I had my beginning inventory and everything that I purchased. So notice everything that I purchased I put in purple. So notice what I'm doing here. I'm doing this column of all the purple guys here, right? And saying anything that I had in the beginning or bought is the number of units that I have available to sell. Now what I'm doing is I'm costing them. So I'm saying, well, I had all of those units available to sell in purple, and the total cost of what I bought, including the beginning inventory that I bought and put into I have an inventory, I'm going to total those costs, because that's going to give me the total cost of these 9,800 units that I have available to sell. And that's going to give me 198.9. So all these little guys here that are in purple, maybe I'll just put them all in there for you so it's clearer. Can't you tell I love working with color? That's just me. I'm a visual person. So now notice that the total of all these guys here is going to be 198.9. And notice that equates to the 9,800 units. So now, how many units did I sell? Well, I sold 7,800 units. Those are the units in red, because it says sale, right? So what I'm doing in part B is I'm costing of the 9,800 units that I have available to sell. I sold 7,800 of them. right? So if I sold 7,800 of 9,800, then I must have 2,000 left. So my 7,800 is going to enter into my calculation in part B for cost of goods sold. And the last 2,000 here in the black color bold and with the yellow highlight is going to be what I'm going to use to calculate the cost of my ending inventory. And don't forget, the ending inventory is going to go on your balance sheet or statement of financial position, and the cost associated with the 7,800 units is going to go on your statement of earnings or income statement, right? But now I've already calculated the cost of goods sold that are available for sale, 198.9. So now here's the other thing. If we know of the total number of units that we had to sell, 7,800, meaning all the ones that you sold during the month are sold, 2,000 are left for ending inventory. That means that this 198.9, which is the total cost of these 9,800 units, should be split up. So I'm going to have, of the 198.9, the cost of the 7,800 that I sold and the cost of the 2,000 that I didn't sell. So this number here, 198.9, should be the total of the cost of goods sold and what I have left in ending inventory, right? So that's what we were trying to tell you up here. When you finish calculating your cost of goods sold and ending inventory, make sure that when you add them together, they add up to the cost of goods available for sale. So not only do the number of units you have available to sell throughout the period equal the total number of units you sold and what you didn't sell, but the total cost of those 9,800 units should total the total value of the 7,800 units that you sold and the 2,000 that you didn't. All right, so now this is just a calculation. This is the answer to part A. So we can see that. But I wanted to do this calculation in more detail so you could kind of see how the little tips are going to help you out when you actually do some of your calculations. So now I'm going to go with FIFO Perpetual. Now notice, don't have a conniption here. Notice here I've done mine a little bit differently than your text does. I think of it a little bit differently, and I would say, well, again, I want to set up a table or a chart that shows me how the goods are flowing into inventory and out of inventory. They do it kind of numerically, and their way is fine. What they do is absolutely fine. It's going to give you the same answer, but this is just a little more visual. So for students that might be struggling a bit with following the flow of the numbers, you might want to use this. I've just typed up a table in Word, but you can do it in Excel any way you want. It'll make the calculations easier maybe in Excel, but this is how I do it. So I'm starting off with what they gave me in the question. They told me I had beginning inventory of $18 a unit. So now in my ending inventory, that's what I have. So my ending inventory so far, based on what I had October the 1st, at the end of October, or the end of October the 1st, I got $36,000 of inventory. Now on October the 3rd, I bought 3,000 more units and I paid $20 a unit for that. So now what do I have? I have my 2,000 units that I bought for $18 a unit here, and this line here, the first line here, and then I have the 3,000 that I bought on October the 3rd. So I'm just keeping them separate, that's all. And I'm saying now I have in total here 96,000 in inventory, 2,000 opening, and 3,000 from my most recent purchase. So on a perpetual basis, I am perpetually updating what's in my ending inventory and what's in my cost of goods sold. I haven't done anything with cost of goods sold yet because I haven't sold anything yet. That's happening now on October the 7th. So what happens? On October the 7th, I sell 2,600 units. Where did those units come from? Well, don't forget, I have to update on a perpetual basis. So did those 2,600 units come from the 3,000, the 2,000, or both? They came from both. Don't forget, 2,600 units, I have to take them out of the beginning inventory first because it's FIFO, first in, first out. Well, of the 2,600 units that I sold, 2,000 came from these guys here, the beginning inventory. So I'm taking them out at $18 a unit. Now I sold 2,600, so the other 600 must have come from these 3,000. So that's why I separate them. When I have multiple tiers of inventory, I like to keep them separated so I can better see where the units I sold are coming from. Right? And I'm taking these 600 out because they're coming from the 3,000 at what I paid for those 3,000 units, which was $20 a unit, right? So now, if I'm costing the 2,600 units, now I'm going to have 36,000 plus 12,000. So far, my cost of goods sold is 48,000 so far, right? So that's that. But what's left in ending inventory? Well, these 2,400 units must have come from the 3,000, because don't forget, from these 3,000 units, that's where 600 that I sold came from. So I now have 2,400 of the 3,000 that I most recently purchased on October the 3rd left. So when I'm costing my ending inventory, I know these 2,400 came from these 3,000, and I bought them at $20 a unit. So now I've got 48,000 left in my ending inventory so far. So now, let's have a look at the next item, which is another sale on October the 15th, and we sold 1,900 units. Well, we've just established after our October 7th sale that we only have 2,400 units left of the 3,000, because I got rid of the first 2,000 I had in beginning inventory. So I can only take these 1,900 from where? These 2,400, because so far, after what happened on October the 7th, that's my ending inventory so far, right? So these 1,900 units that I sold must have come from these 2,400, which are sitting in my inventory to cost of $20 a unit. So now my cost of goods sold on that sale is 38,000, right? So how many units do I have left? Of the 2,400 that I had at the end of October 7th, I've sold 1,900, so I've got 500 left at $20 a unit. So now my ending inventory is 10,000. But notice, what's my cost of goods sold so far? Cost of goods sold is cumulative because it's for the entire month of October, right? So in this case, I had 48 plus 38. I'm going to have 86,000 so far in my cost of goods sold, but I only have 10,000 in ending inventory, right? Now, what happens? On October the 23rd, I bought another 3,000 units. So now here's my tiered approach. I have 500 left from these 2,400. So they're sitting in inventory at $20 a piece. And then I have these 3,000, right? Here, that I just bought, sitting in my ending inventory at $22 each. So I have 66,000. So far, I have 76,000 in ending inventory after my October 23rd purchase. But wait a minute. On October the 29th, I now sell 3,300. Where do those 3,300 units come from? On a FIFO basis, they come from the first ones in, and I have 500 that are left of these 2,400 that, don't forget, originally came from the October 3rd purchase. So these 500 are coming out first, right? All right. And then, once I take out those 500, right here, right? So these 500 are coming out. What's left to take out? Well, I need another 2,800. But these 2,800 are going to come from where? The 3,000 that I just bought on October the 23rd. So now they're coming out at $22 a piece. So I'm going to have these 3,300 units I'm costing, but 500 are coming out at 20 bucks and 2,800 are coming out at 22 bucks. So now my cost of goods sold has been increased by 10,000 plus 61,600, right? So my cost of goods sold over the month of October is going to be $157,600. How do I know? First of all, that's a purchase, so that's got nothing to do with cost of goods sold. So because that's the last thing that happened in October, that's not going to impact my cost of goods sold. It's a purchase. It's going to impact my ending inventory. But at least I know that over the month of October, I have a cost of goods sold that when I total it, is going to be $157,600. Now, I can double check too my cost of goods sold. All these guys in red here the total number of units that I sold, 7,800. Shouldn't that be what we talked about in part A, right? So when you're doing your chart or your calculations, you should always try doing these parts first, looking at how many units do I have to sell and what's the cost of them, and how many units did I sell and how many units are left, right? So we already know that in cost of goods sold we should be costing 7,800. Let's see with our ending inventory if we've got 2,000 units left. Well, we already know, because we know here that once we sold the 3,300 units, we would have what left? 200. 200 that came from here, because don't forget, of the 3,300 we sold, 500 came from what was left of the October 3rd purchase, and don't forget the other 2,800 came from what we recently bought on October the 23rd, which is from these 3,000. So if these 2,800 came from those 3,000, we have 200 units left, right? And those 200 units are sitting at $22 a pop, or $4,400. But if we bought 1,800 more on October the 31st, those 200 plus these 1,800 are going to give us 2,000. But what's the cost of them? Don't forget, these 200 are in inventory at $22 a piece because they are from the October 23rd purchase, right, up here. And the 1,800 are what we just purchased on October the 31st, which are sitting in our ending inventory at $20.50. So if we add together these two amounts for ending inventory, we're going to get $41,300. So if we add the $157,600 in cost of goods sold to our ending inventory, this is the cost of the goods sitting in our ending inventory. This is the cost of goods that we sold. The two together should give us the cost of goods that we had available to sell throughout the month of October. Because of the $198,900, which is what we had available to sell, $157,600 is what we sold, and $41,300 is what we didn't sell. So just as we said here, make sure in your little tip that when you add them together, the cost of goods sold in the ending inventory, it gives you the cost of goods available for sale. So that's why we did that. So this is an example of how you would calculate under a perpetual system, FIFO, your cost of goods sold and your ending inventory. So now, in the second part of the video, I'm going to focus now on FIFO periodic. All right? So this concludes this little segment on FIFO Perpetual and calculating your cost of goods available for sale.